This is Raag Bhatia, and this is my second presentation for the retirement group. I'm summarizing the book The Intelligent Investor by Benjamin Graham. Benjamin Graham, or Ben Graham, is known as the father of value investing. He started teaching the concept in Columbia University in 1928. Some of his followers include major investors like Warren Buffett, William Ruane, Irving Kahn. He wrote The Intelligent Investor in 1949. It's known as the Bible of Wall Street. This is a graph of cumulative returns. The SI index here was created for a previous presentation for the retirement group. It takes into account 8 value investors and their average yearly returns. Now if you compare them to other indexes like S&P 500 and Russell 2000, you can see they have much less volatility and greater returns. The intelligent investor. What is the intelligent investor? An important point we need to take into account is we need to differentiate between investing and speculation. In the words of Ben Graham, an investment operation is one which upon thorough analysis promises safety of principal and an adequate return. Operations not meeting those requirements are speculative. If you want to speculate, do it with your eyes open. You should limit your amount of risk and not mix it with your investments. What you need to look at is not IQ. The book shows an example where even Isaac Newton gets influenced by a market and ends up losing about what would be $3 million US today. What you need is patience, discipline, thorough fundamental analysis of companies in which you invest, a margin of safety, and you need to work to adequate, not extraordinary, your performance. You need to look at a satisfactory ratio of earnings to price, a company with a sufficiently strong financial position, and the prospect that its earning will at least be maintained with the years. He mentions that there is a paradox in that more successful a company, the greater the fluctuations in the price of its shares, which really just means that the better the quality of a common stock, the more speculative it is going to be. The speculator's interest lies in anticipating and profiting from market fluctuations, whereas an intelligent investor focuses on acquiring suitable securities at suitable prices. Aim to be an intelligent investor, not a gambling speculator. The dot-com bubble. It was the result of a combination of rapidly increasing stock prices, market confidence that the companies would turn future profits, and a lot of individual speculation in stocks. All of this led a lot of investors to overlook merits like the price-earning ratio in favor of confidence in technological advancements, companies like Amazon.com. And then the bubble burst. Amazon stock went from $107 to $7 per share. The Nasdaq Composite, as shown here, lost 78% of its value from the peak as it fell from 5,046 to 1,114 points. He says that basically there are 2 types of investors, the defensive investor and the enterprising investor. The defensive looks for safety and freedom from bother, but it's more emotionally demanding, whereas the enterprising investor aims for higher returns through active effort, and that's more physically and intellectually taxing. You don't have to be either one, you can always find a blend between the two. So here are some of the principles that Ben Graham points out for the defensive investors. You should not, when you're looking at companies to invest in, they should not have less than 100 million of annual sales, which comes to about $500 million today. Its current assets should be at least twice its current liabilities. Long-term debt should not exceed the net current assets. Some earnings for the common stock in each of the past 10 years. Uninterrupted dividend payments for at least the past 20 years. A minimum increase of at least 1/3 in per share earnings in the past 10 years. The current price should not be more than 15 times average earnings, and the current price should not be more than 1.5 times its book value. He argued that dividends are a sign that a company is profitable. Dividends are paid from profits after all, and they will offer investors a return even if company stock does not perform well. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one. That's why defensive investors should diversify, as you have to make sure that you're not overexposed to one industry. Now, when we look at the principles for enterprising investors, they're very similar but a bit more latitude as they're more actively involved. Again, the financial condition, the current assets at least 1.5 times its current liabilities, debt not more than 110% of net current assets for industrial companies, no deficit in last 5 years, some current dividend, last year's earnings more than those of previous year, price should be less than 120% of net tangible assets. Sound advice again, don't focus on the price, focus on its value. What he emphasizes a lot is you need a business-like approach towards investing. A stock is the ownership interest in an actual business with an underlying value that does not depend on its share price. Again, focus on the intrinsic value of a company. He says that never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. The market is emotional. Don't just dump a stock if its share price falls. Sell it only if you feel the business's actual value has dropped. Graham also argues that it's beneficial to thoroughly research and understand the inner workings of a company when an investor is considering buying shares and assessing the actual value of an ownership stake. Simply watching its ups and downs is far too shallow an approach. A quote by Peter Lynch, "Behind every stock is a company. Find out what it's doing." When looking at returns, Penrose says that future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. You need to take into account certain factors, like you need to consider inflation and taxes, and profit should be measured after taking these into account. You need to know that business cycles are inevitable. If you're currently in a bull market, know that a bear market is around the corner, and that is where the value investors should take advantage. You should expect fluctuations, and timing does not matter. You leave worrying about market fluctuations to the speculator. Investors should be more interested in obtaining sound securities. What you're looking at in a company is its long-term prospects, its management quality, financial strength, capital structure, dividend record, all the things mentioned in the previous slides. The investor with a portfolio of sound stocks should be expecting the prices to fluctuate and should not concern himself with sizable declines or become really excited with sizable advances. Investing is not about beating others at their game, it is controlling yourself at your game. Here's a graph. We are looking at inflation and comparing that to the stock market annual growth rate. And as you can see, stocks generally do bad with low inflation. With moderate inflation, they do well, and high inflation is usually worse. It's kind of erratic. The highest returns are usually with inflation being around 2 to 3%. Margin of safety. Risk can be changed, but not eliminated. No matter how careful you are, You cannot eliminate the risk of being wrong. That's why Graham insists on keeping a margin of safety. This just means that you buy at a big enough discount to allow some room for error in your estimation of value, and it helps to pad potential losses. It can minimize your odds of error. This question, he argues, will give people the courage to keep the rest of their money in stocks even when the stocks sink. You can't just focus on getting your analysis right. You must also ensure against loss if your analysis comes out to be wrong. Other things you can do to protect is diversify. Another quote, there's a close logical connection between the concept of a safety margin and the principle of diversification. For the margin guarantees only that an investor has a better chance for profit than for loss, not that loss is impossible. On the same principles as before, he says the secret is you. You need to be a critical thinker and not take the market on faith. Keep a contrarian approach. Use the dips in the market as points to acquire more of quality stock, along with finding new opportunities for suitable investments. Interpret, don't just follow. You need to develop your mindset. You can't be impulsive or let emotion get in the way of rationality as created by value investing theories mentioned before. He says in the end, how your investments behave is much less important than how you behave. Another wise comment by Warren Buffett, be fearful when others are greedy and greedy when others are fearful. Don't forecast the future exclusively by extrapolating the past. Don't buy into the hype of strong bull markets or trust experts too much. And you should stay humble about your forecasting powers. That's why you always have a margin of safety. Here he looks into investment options. Talks about investment funds. The higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Again, all of these are based on previous concept that we have gone through. Highly volatile funds are likely to stay volatile. Funds with high past returns are unlikely to remain winners for long. Index funds are the best choice for individual investors. And when looking at mutual funds, its merits are that the managers are biggest shareholders, they're cheap, they dare to be different, and they limit their clients. And when looking at mutual funds, you should be looking at the fund's expenses, its riskiness, the reputation of its manager, and its past performance. Here's a checklist based on the same principles that we have gone through that Benjamin Graham would personally go through every time he looked into a stock. The father of value investing followed his principles till the end, and he would by hand go through all of these points when looking at different stocks. Some of the other tips from the book is that you should keep a minimum of 25% in bonds for safety and maximum of 75% of total assets in stocks. Don't invest in just a few stocks. And red flags for defensive investors is if you end up trading more than twice a year or spending more than an hour or two per month on investments. Day trading carries extreme risk. IPOs are frequently overpriced. Treat junk bonds with skepticism. Keep extreme caution when buying foreign bonds. A great company is not a great investment if you pay too much for a stock. And look at price earning ratios. If they go above 25 to 30, then the risk is getting high. You should keep a lookout for temporary unpopularity, which enables you to buy a great company at a good price and diversify a portfolio. An additional tip from the commentary offered in the book is you should not let the ease and up-to-minute feel of the internet seduce you into becoming a speculator. In conclusion, investment is most intelligent when it is most businesslike. The market is not efficient. Reason and long-term thinking over emotion and short-term impulses will generally guarantee a success. Again, breaking value investing down, you need to look at lower than average price to book or price to earning ratios and or high dividend yields. Don't just follow, interpret, make informed decisions, take advantage of a depressed market, and always have a margin of safety. Thank you.